Alright, so welcome back to the second half of chapter 9. So we just finished talking about this problem, and this is going to be our loss right here, this 1,000. And remember that losses and gains are part of shareholders' equity and are going to show up on the income statement. They're just technically not revenues and expenses because expenses and revenues are part of like the day-to-day operations of a company, whereas technically like a gain and loss, they call it like a incidental transaction. So it's not something that the company does all the time. So it's basically a revenue and an expense. It's just classified differently. So it has like the same debit credit rules. It's going to affect income the same way. It's not a revenue expense because it doesn't happen all the time. And you can actually switch for the equation. You can actually switch these, and that will give you, like, if it's a positive number, that will give you cash. Whereas what I have written right now, the positive number gives you a loss. So that's my bad if that kind of didn't make sense to you. All right. So with that being said, let's talk about the activity method now. So ABC Trucking Company purchased a truck for $100,000 on July 1st, 2016. The useful life of the truck was estimated to be 5 years or 200,000 miles. The salvage value was estimated to be $10,000. What is the depreciation expense for 2016 under the activity method if the miles logged for 2016 was 50,000 miles? So the first thing I would notice about this problem is that we're using the activity method, which means we have years and miles for a useful life. And since we're using the activity method, we don't really care about the years. We're only going to care about this 200,000 miles. So this is how long we think the truck is going to run for. And again, kind of the same steps as before. We have the cost minus the salvage value divided by the useful life. So before, when we were doing like the straight line method, this would give us our depreciation for every year. But since this denominator isn't in years anymore, it's in miles, this is going to give us now like depreciation per mile. And this is going to be, let me get on my calculator. I have 0.45. So this 0.45 is going to be our depreciation for every mile. All right. So now it says that in 2016 we used the truck for 50,000 miles. So again, depreciation per mile is how many miles we used it. So it's just 50,000 times 0.45. And we get 22,500. So then at the end of 2016, they would record a depreciation expense of 22,500 and accumulated depreciation of 22,500. So really quick, let's just say that I asked you what was the carrying value at the end of year one. Pause the video and try and do that really quickly. All right. So again, the carrying value is just going to be the cost. Remember cost. It's not the depreciation base, but it's cost. Cost minus your accumulated depreciation. We've only had 1 year so far. So this 22,500 is the only thing that we have. So it's just going to be 100,000 minus 22,500. And whatever that number is going to be your book value, 77,500. All right. So let's talk about a little wrinkle that I threw into this problem. And I'm sure maybe one or two of you noticed it while as you were reading the problem. And that is I made the purchase date kind of in the middle of the year instead of the beginning of the year. So as you can see, they purchased it on July 1st, 2016. So in the activity, or some of you may have thought to like decrease the depreciation in half, except you wouldn't do that for the activity method because we care about the miles, not the time. But if it was a straight line method, then we would, because we only used it for half a year. And the number that we get from doing cost minus salvage value, so the depreciation base divided by the useful life, that gives us our depreciation for every year, right? So then we would divide it by half because it's only half a year that we're using it. Whereas in the activity method, we don't care about the years. We only care about the activity. So the activity isn't dependent on so we use the 50,000 in 6 months. So we just use the 50,000 miles. That hopefully that made sense. So last slide for chapter 9 that I'm going to go over is just like some other stuff. So this question was on your chapter 9 quiz, and I noticed that most people got this question wrong. So which of the following statements is correct? So let's look at A. Straight line depreciation is an accelerated method of depreciation. That's not right, because we know of one accelerated method of depreciation, and that is the double declining method, which we'll talk about in a second. The total amount of depreciation taken for an asset over its useful life differs depending on the method used. So this actually is incorrect, and this is what a lot of people circled, and we'll talk about why it's not that in a second. In the later years of an asset's useful life, straight line depreciation gives lower expense than does declining balance. In the later years of an asset's, we'll talk about this one in a second too. So D, the total amount of depreciation taken for an asset over its useful life is the same regardless of the method used. So this is the correct answer. And the reason being is it says over its useful life. If it said over a single year or something, then the amounts would be different. But remember, in all the activity method, the straight line method, and the double declining method, the numerator was always cost minus salvage value, our depreciation base. So saying basically if it said the total amount of depreciation, it could have also said the depreciation base for the asset is the same regardless of the method used. So the depreciation base is just how much we depreciate over the life of the asset. Now the amounts from year to year are going to be different on them depending on what method you use, but all in all, over the life, you're going to depreciate the depreciation base for every method you use. So that was the first point that I wanted to make. Now let's talk about what assets are actually depreciable or depreciated. So remember, the only thing that isn't depreciated is land, or the long-term asset that's not depreciated is land. The reason being is because it is permanent. So if we tried to figure out a denominator or a useful life, it would just be infinity, and thus it would be weird trying to figure out the depreciation per year. I'm running out of time again. All right. So I guess I'll just make a third part to this. Yeah, I'll just make a third part. All right, so see ya.